Buying a UK property investment in today's market is more challenging than ever. With the recent rise in mortgage interest rates, increased costs, but also stricter tax regulations, well, making a profit from property is harder to achieve. And many landlords who once did enjoy those rock bottom mortgage rates are now facing higher payments. Currently, nearly 2 million buy-to-let properties have a mortgage, according to UK Finance. And with mortgage interest rates fluctuating, the big question for landlords is buy-to-let still worth it? Even with the recent Bank of England rate cuts. In this video, I'm going to break down a brief history of mortgage in the UK, the factors that influence your mortgage, but also whether all of this is good news for the economy. Stay tuned. To give some context in today's UK mortgage crisis, it's important to look at a brief history of mortgage in the UK. In fact, if we look at the average mortgage here in the UK between 1995 and 2022, we can see it's an average of 5.6%. And if we look at the peak within those last 25 years, we can see that was in 1998, peaking at 8.8% in September. And in the same time frame, the average mortgage interest rate was at its lowest in 2021. When it was recorded at 3.5%. If you have good memory, you remember this created a race for space, a housing buying boom, and an increased activity in refinance. It is important to remember that short-term changes in mortgage interest rates doesn't impact mortgage borrowers, since the majority of them are going to be on the fixed-term mortgages. In fact, 75% of people have opted to have fixed-term mortgages. And in 2019, over 90% of new mortgage applications actually opted for these fixed-term rates. Looking at the Bank of England base rate, we can see that throughout the 80s, it was pretty much double digits, even into the early 1990s, and then it varies. But specifically, if we look at after 2009, we can see there was cheap money, and buy-to-let investors made the most of it. If you're finding this video helpful, smash that like button. It really motivates me in pushing more of these videos out there. Mortgage rates have obviously surged since then, putting a lot of landlords under increasing pressure. And they've seen their payments, the monthly payments, probably even double and even triple. So let's look at current mortgage rates for buy-to-let as they stand from now, from a few weeks into 2025. Obviously, with the change of rates for the Bank of England, that's going to change slightly, but not substantially. Let's look. The average 2-year fixed rate stands at 5.39%. The 5-year at 5.56%. The lowest 5-year fixed rate, 3.49%, but that does come with high fees. And the lowest 2-year fix at 2.59%, again, with high fees. So for a landlord with £200,000 interest-only mortgage, at 5-year fixed at 5.6%, you're going to end up paying around about £926. And this isn't without considering, of course, service charges, any letting fees, void periods, maintenance costs, regulations, and so forth. And that being said, more landlords are shifting to a limited company structure to reduce their tax burden. And we can thank Judge Osborne, the then Chancellor for the Conservative Party. And what he did was remove the ability for landlords to add their interest from their mortgage as an expense. So of course, right now, or at least in 2024, we did see over 46,000 limited companies for buy-to-let properties, over 20% increase of the previous year. The key difference in mortgage rates for limited companies: 2-year fixed rate 5.64%, 5-year fixed rate 5.81%, higher fees but full tax deductibility on mortgage interest. For a £200,000 limited company landlord will pay roughly on a monthly basis £940 for a 2-year fix. And then for a 5-year, you're looking at over £960. Of course, the key here is that it's tax deductible. While fees do tend to be higher, the tax advantage often outweighs the additional costs. Many landlords are now remortgaging from rates as low as 2.5%, of course, a massive jump from today's rates. In fact, if we take an example of a landlord of £200,000 interest-only mortgage, we know that they could have been paying as low as almost £400 at a 2.5% rate. Now, today's rates, they could be paying over £920. The good news is that rates have come down from the peak of mid-2024, when 5-year fix almost hit 7%. However, landlords do need to shop carefully because the lower rates do come with huge product fees, some hitting even at 10%. To get the best deals, landlords should, number one, speak to a mortgage broker, hopefully a recommended one. Now, if you don't have one, follow the link on the description. We have recommended mortgage brokers across the country. Number two, compare the whole cost, not just the headline rate. And number three, have 40% deposit or 40% equity. So let me take out my crystal ball and let you know at least what the experts are predicting for 2025 and beyond. Now, one of the hardest things for landlords and property investors is timing their mortgage. However, sometimes it's impossible, right? But right now, at the beginning of 2025, we have had one rate cut from the Bank of England, and we're now at 4.5%. Industry experts are predicting another 2 rate cuts, bringing us to the end of the year of around about 4%. In 2026, further drops are possible, with some predictions as low as 3.25%. 2027, some economists expect rates to settle between 2.5% and 3.5%. Two major banks, Morgan Stanley and Goldman Sachs, predict that the Bank of England are going to cut rates faster and deeper than what the market expects. Now, if this is true, then we could expect better mortgage rates for the years to come. However, the Bank of England has given us a word of caution, starting off with the Labour's budget. Yes, the impact that it's having on the economy and the big companies. We've seen several supermarkets already cutting jobs. This is the back of the increase of national insurance and the increase simultaneously on minimum wage. And we've seen a lot of other companies, thousands of companies, following suit. And there are also other factors to consider outside of UK control, such as what's happening across the pond with our US cousins and the unpredictability of the new government. So that's something that people are definitely keeping a close eye on, not only here in the UK, but across the world. Should you fix or choose a tracker? First up, a disclaimer, this is in no way financial advice. But if we look at 5-year fixed, pros and cons, the pros, well, first up, you're going to get a better rate than a 2-year. Second up, you're going to have more predictability. And number 3, you're going to have affordability. Tests are going to be easier. With the cons, you could miss out on cheaper rates if interest rates fall further, higher early repayment charges if you want to switch. This is best for landlords looking for stability, those who want to borrow more, and for those who don't want to risk any rate hikes. And the pros for fixing for 2 years, well, you have more flexibility to remortgage if rates do fall, but also for those landlords who do expect for mortgage rates to fall within the next 24 months. If, of course, you believe what the experts are predicting, then this may be a good choice. But one thing with regards to the cons is, number 1, strict affordability test than 5-year fixes, and you could face higher rates in 2027 if rates don't drop as expected. This is great for landlords who believe that rates will fall further and want that flexibility. Let's turn to the pros and cons of tracker mortgages. So with trackers, it follows the base rate of the Bank of England. So if that drops, your monthly payment drops automatically. The pros, well, there are no early repayment charges, meaning that you can switch at any time. Number 2, you can benefit from falling mortgage rates. And the cons, well, rates could rise, making repayments unpredictable and currently more expensive than fixed rates. This option is definitely not for the faint-hearted. It's for landlords who are absolutely certain that mortgage rates are going to fall substantially. Now, I've seen a lot of landlords and property investors find themselves in a bit of a pickle when they bet against the market. But this is not for me to say. The buy-to-let mortgage market is evolving rapidly, which is exactly why you should subscribe to this channel so you don't miss a thing. So key takeaways from this is that the mortgage rates right now are lower than the peak of mid-2024. Experts predict mortgage rates coming down in 2025 and in 2026. More landlords are opening limited companies to make sure that they're more tax efficient. And always factor in the total mortgage cost, not just the interest rates.